This chapter is built around 4 dramatic real-world stories, each an extreme case that teaches a simple lesson about what not to do with other people's money. Graham calls them extremely instructive because they show extremes of market behavior, accounting oddities, and plain bad judgment. The 4 cases are Penn Central, Ling Temco Vought, LTV, NVF's takeover of Sharon Steel, and AAA Enterprises. Each story exposes a different kind of marketplace failure, and the commentary updates the same themes with modern parallels. Penn Central was a giant that went bankrupt. Its story is a classic example of how obvious warning signs were ignored while the market priced the stock at stratospheric levels. Key red flags Graham highlights. Interest coverage ratios far too low for a railroad, almost no income tax paid for many years, which suggests the earnings were fragile. Terrible operating efficiency compared to peers, and massive post-merger one-time charges that made the published earnings misleading. The practical moral: if basic credit coverage metrics and operating ratios look weak, don't trust a high stock price. Big companies can still be insolvent. LTV shows the danger of breakneck empire building funded largely with borrowed money. Sales exploded into the billions, but so did debt, and earnings couldn't keep up. Banks kept lending, and the company kept buying, until losses wiped the equity out. Graham's takeaway: runaway acquisition programs supported by easy bank credit can create a house of cards. Watch leverage, recurring coverage of interest, and whether profits are sustainable, not just the headline growth. This is an extreme minnow swallows whale story. Tiny NVF paid for a much larger steel company mainly by issuing deeply discounted bonds plus a mountain of warrants, and then used creative accounting, deferred debt expense, excess of equity over cost, odd amortizations to hide the true deterioration in equity. The deal created huge dilution and a balance sheet where market value of warrants exceeded the stock itself. Lesson: when you see complex purchase consideration, big non-cash balance sheet items, or a firm that issues debt/warrants to buy a giant target, do the arithmetic. How much real equity remains and how much dilution is hidden in footnotes? AAA was a small franchising/mobile home company that IPO at an absurd multiple of earnings and doubled immediately. Inside a year, it reported catastrophic losses and filed for bankruptcy. This is Graham's lesson on hype, underwriter responsibility, and the public's appetite for fads. People bought stories, franchising, hot sector labels, not economics. The takeaway: a hot IPO and immediate price jumps aren't the same as sustainable business value. Graham's commentary points out that these patterns repeat. He and the modern annotators mention later examples. Technology giants that hid bad assets in goodwill or customer financing, conglomerates that used non-recurring charges as routine accounting plumbing, mergers of wildly mismatched companies driven by market fashion, and dot-com-era IPOs that sold dreams instead of earnings. All the modern examples underline the same principles. Don't be dazzled by growth alone. Rapid revenue growth can mask poor margins, unsustainable customer financing, or capital that's really speculative goodwill. Check the balance sheet and footnotes. Deferred assets, large warrant programs, odd amortizations, and huge goodwill are all places where problems hide. Watch leverage and interest coverage. Companies that borrow to buy growth and whose operating cash can't reliably cover interest are fragile. Beware management storytelling and repeated non-recurring charges. If every year has one-time charges, they're not one-time. Hype and market momentum aren't the same as intrinsic value. IPO pops and stock splits don't create business profits. So, what should you remember when evaluating a company? Read the interest coverage and operating margin trends. If those are deteriorating, be cautious. Scan footnotes for deferred debt expense, goodwill write-ups, warrant programs, and customer financing. Quantify them if you can. Calculate fully diluted shares and adjusted EPS if convertible/warrants exist. Don't accept headline EPS at face value. Ask: is growth funded by real cash profit or by borrowing, accounting shifts, or one-time book entries? When a company is doing lots of acquisitions, check whether acquisition costs and related charges are recurring. For IPOs or hot issues, require a clear, repeatable earnings story, not just a catchy business model or franchise pitch. To conclude, Chapter 17 is a tour through spectacular marketplace mistakes. The specifics differ: railroads, conglomerates, takeover accounting, hot new issues. But the investor's protection is always the same. Do the simple, hard work. Read the footnotes, check leverage, demand real cash economics. Maintain skepticism about marketing and hype, and insist on a margin of safety. If you do that, you'll avoid most of the disasters Graham describes, and you'll be in a much better position when a genuine opportunity shows up.